yesterday, Central Bank concluding its first rate-setting meeting in the new year on Tuesday and leaving all interest rate parameters unchanged in line with economists' consensus. Drilling down the policy meeting and what it means for the economy and markets, even as the U.S. Fed decides today, is Nnamdi Nwizu, is a co-managing partner at Commercial Partners here in Lagos, live here in our studios with me. Good evening. Thanks for making it come.
My pleasure.
Thanks I appreciate your coming. It's the first time in the new year. Thank you. It's good to see you.
Great. Same to be.
Great. So we're bringing you in on a very important point when we look at the central bank monetary policy. Was this decision of yesterday consistent with your views at Commercial Partners?
Basically, I'll say it was, because if you look at the central bank over the last couple of years, they've basically employed unorthodox tools, monetary policy tools, in trying to manage in monetary policy, inflation, and co. So we're not surprised. We've seen very little come out from MPC in the last 1 year plus. They've kept rates steady, they've kept all parameters steady, and basically, like I said earlier, use other tools to manage their policy. So not surprising, and what we all expected.
Well, all expected, but what about the key considerations? Because whether central bank do something or do nothing, there are always considerations for doing nothing and consideration for doing something.
I agree.
Whether to hold, to raise, or to lower. There's always considerations.
Definitely. So what we think they looked at, one, they considered inflation. We saw an uptick of inflation when the December figures came out. But they considered that basically due to the festive season. You know, all the buying that happened in December, and that's what basically caused that. They considered the fact that they need to still stimulate growth. We are still not where we are with regards to growth and GDP. So they don't want to create a situation or a scenario where, you know, they start to tighten aggressively and then the economy starts to suffer. So they try to ensure that they continue to create an accommodative environment, right, for interest rates. Then the other thing they looked at was the possibility of the Fed, or rather when the Fed will start tightening. We're expecting the Fed news to come out anytime soon. But they consider that and also, you know, realize the fact that, look, they are focusing more on inflation, right? That's why they are increasing rates. And we are on a different tangent because we are still trying to stimulate our economy. So, I mean, based on all of that, they decided, look, the best thing is to hold.
If you look at inflation in December, the data from NIBS says that nearly 700 billion POS transactions were done last month. I thought there's no money. So why did you guys spend money?
Well, that's why you saw the inflation figures go up, right? So Nigerians are people who would always spend money in December. You know, I remember working somewhere once where they stopped paying salaries early in December, because what would typically happen is that by January, everybody comes and says they want to collect salary advance. So it's not surprising. We've seen huge growth in electronic transactions in Nigeria. It's been massive. And even, funny enough, been in a few conversations recently where people seem to be moving from ATMs to more of POS for cash collection, right? Especially in the hinterlands, you know. So it's not surprising that you continue to see the figures grow, and it makes a lot of sense.
So in a way, we're biting something there. How impactful do you think today's U.S. Fed decisions will be on Nigeria's interest rate outlook moving forward?
Well, unless they do something extremely aggressive and totally out of market expectation, which is about 3 or 4 hikes this year, which will come to about 100 basis points, by 1%.
Goldman Sachs is predicting 7.
7, well, so people are saying 3, 4 this year, and then have another like 3 in 2023, right? I've not seen any prediction for 7, so that must be first to have 7 this year. But still, people are expecting by 100 basis points, 125 basis points this year. So if they do that, no surprise, don't expect much to happen with regards to our interest rates environment. We already know, or rather the MPC already knew that before they went ahead to take their decisions. However, if we continue to see rates increase, it might make the Eurobond market a bit unattractive for issuers, and Nigeria might have to resort a bit more to the local market to borrow, which then could have a ripple effect, because that means they'll have to issue a lot more local securities, debt, federal government debt, and that could push yields up a bit.
But again, how should we position it if I'm investing in the market knowing that the Fed is ready to move? And the Central Bank of Nigeria will also have to prepare for that move.
Yeah.
So how do we position for what will be the impact on exchange rates, on a whole lot of things? Or will we just wait and let it happen?
Well, if you're an investor who has access to foreign markets, right, USD type investments, a good time to put the gunpowder, right, in your gun, because what happened basically that you see asset prices crash. We saw that happen in 2020. We saw that happen in 2016. That happened in 2009. But they always recover, and that's a good time for you to go in and get assets on the cheap, right? For the Nigerian perspective, the central bank would have to try and get a bit more creative or continue to do a lot more of their swaps, because what has happened now is they've basically cut off your regular FPIs that would come in and buy automobiles and basically buy risk rating rates. And what they do, they have targeted swaps at certain individuals where they do large ticket sizes, like $100 million and above. So what it means is that they should be prepared to pay a bit more, because naturally when the cost of dollars goes up, then they would have to pay more to access those dollars, right? So I think from that perspective, the central bank needs to be prepared to pay a bit more and try and focus a bit more on their swaps, since they don't want to have general rate raised across the spectrum.
Well, the central bank believes that we're not likely going to see much of an outflow from our own markets when the Fed starts raising rates, says that we're in a bit of a comfortable position. Do you think we have enough of foreign participants across all our market segments so as not to get us panicking? The central bank governor says we don't have to.
Well, so over the last 1 year plus or 2 years, we've had very few foreign portfolio investors, and they are typically the ones who tend to run away first when you have, volatility, this type of volatility. And basically, like I said, the central bank had decided that instead of raising rates, right, and increasing MPR, increasing OMO rates, what they've done is, look, we just debit CRR, which is our own way of reducing market liquidity at zero cost, and they use that now as a tool, which is what I said earlier on unorthodox methods. They use that more as their own tool to manage interest rates and interest environment. So a lot of the foreign investors that would typically have, come in when Nigeria had raised rates, no raise rate happened. So a lot of them went out ages ago and they just haven't come back in, and they're all waiting, hoping that Nigeria gets to raise rates at some point in time, and so they can come back in.
Are we likely to raise rates anytime this year?
Doesn't look very likely unless things really get out of hand. I think the central bank most probably still resort to, CRR debits and co to manage market liquidity. Because when you're raising rates, you're trying to basically reduce liquidity in the system and try and attract foreign investors. If you debit CRR, you reduce liquidity in the system. If you have your swaps, targeted swaps at certain investors, you get your FX inflows that you're expecting. And they seem very comfortable with that, and we've done that over the last 2 or 3 years.
What happens at the Eurobond market offerings by sovereigns and corporates in the new year, 2022? Who's going to smile and who's likely going to be hair-scratching as to, this is what is going on?
Well, if you see the rate hikes start to happen, it will most probably make the Eurobond market a bit more inaccessible, right? We've seen Ghana already come out to say, look, they're most probably going to cut down on whatever they plan to raise in the Eurobond market, or maybe not even go there at all. You look at Ghana rates now at about 13% versus most of the coupons on their bonds, which are about 7-8, which shows you where typically they borrow, because the coupon tells you where they issue the bonds. So they typically borrow at about 7-8%, same thing with Nigeria. And now you have your yield at 13%, 14%, which means that if they were to come into the market to borrow, they'll be borrowing at where the second market rates are, and nobody wants to pay that premium. And even if you look at Nigeria, typically the same thing. And if you go to the corporate market, if the sovereigns are trading at about 10%, 9.5, 10, Nigeria, and places like Ghana, Ethiopia at about 17, 18%, the corporates won't borrow lower than sovereign. So that means they themselves will have to pay a premium. So you might see a lot of them staying away from the market and waiting for things to normalize before going, headlong.
So it was a bit of a prescient kind of when we went to the market last September to do the 4 billion
Yeah. I mean, last year was a bit of a record year for Eurobond issuances. You had so many African countries, SSA countries coming to the market, based on the fact that rates, market was awash in liquidity, all the easing from the Fed, so everyone looking for where to put money, and they push rates down aggressively.
So the era of cheap money is almost over, my friend.
For now, until the next global crisis.
The IMF says we're going to get our 2.7% growth outlook for this year. That was retained in the latest World Economic Outlook. You think that's good enough? You think we're in good shape?
Well, yeah, if I look at our own in-house expectations, somewhere between 2 and 3%. I know some of the sectors are struggling. Petroleum sector is still struggling in energy sector due to things like decaying pipelines, continued bombing of pipelines. You also have the struggle to bring back, the plants that had been shut down in line with OPEC quota, right? So we've not been able to take full advantage of the rise in crude oil prices. OPEC quota for us about 1.6, we are still producing about 1.2, 1.3. We've struggled to meet that, let alone our installed capacity, which is about 2.1. So until we can resolve that, it's going to be a bit difficult. Q3, Q4 last year, 2021, GDP growth was about 4% or thereabout. But we don't think we can keep that up naturally because you're coming from a higher base now. We are coming from a low base of 2020, yes. COVID-induced, COVID-ravaged economy.
Now the level is high.
Yeah, so things have normalized a bit last year.
So you got to catch up. It's like climbing a mountain. Yeah,
so it's going to be difficult. So which is why 2.7, which ideally is very low for a developing country like Nigeria, but based on
what do we really need?
Should be in 6% levels.
6 or 7.
Yeah,
that's your take.
That's where we should be. But I think we'll be about 2 to 3. But we should be at about 6. Based on the fact that we're a developing economy, we should be at about 6% GDP growth.
Steadily.
Sorry?
Steadily.
Yeah, that's where we should be. Yeah, if you look at China, China has been at 5-6%. Right? So even if you look at when your GDP growth is way lower than your inflation, then it's even a problem for you.
And your population rate.
And your population rate, yes.
Interesting. Let's do that. Thank you so much. It's nice having you. Thank you for your time and insight tonight. Nnamdi Nwizu, the co-managing partner at Commercial Partners. We'll see you next time.